Hello, my name is Carlos McWhorter, CPA, and one of the biggest questions that investors have to answer for themselves is, are we in a market bubble? Is the market so overvalued right now due to AI, with all the hype and euphoria and funding going towards AI? Are we in a bubble and really this thing is going to come crashing down soon? Or are we safe and maybe we're gearing up for what they're saying is a soft landing with the economy? So in this video, I'm going to go over stock market bubbles, what they look like, the elements of it, even the psychological and things that goes on in the market and in the minds of investors that causes the bubble, and even a historical analysis looking at past market bubbles to see how this position that we're in right now compares to the bubbles in the past. And that will give us a clear picture of where we are. So let's get into it. So how market bubbles work. So again, I'm going to go over what a market bubble is, how do they happen, the stages and the structure of a stock market bubble, and also historical review of the bubbles. And at the end, we're going to go over what action should we take, how should we think about moving forward so that we don't fall victim to stock market bubbles. So number one, what is a bubble? A market condition where asset prices are significantly higher than their intrinsic value. So there's a difference between price and value. Price is what you pay, value is what you get. As an investor, you always have to keep that in mind. And when you're buying a company, you're buying something that has an underlying asset. You're buying ownership in a business, and you always want to think about what that value is of that business when you're buying. You don't have to necessarily do all the math and be a scientist when it comes to discount cash flows, or I should say a mathematician when it comes to valuation. However, you have to keep that in the back of your mind because you don't want to be caught holding the bag or overpaying for a business, because that will hurt your returns. And then when this happens in a major way in the stock market, it creates a fragile system where things may look good, but they're actually fragile, just waiting for one type of event to spur a major sell-off of stocks and the whole stock market comes crashing down. So the characteristics of a market bubble, there's two sections. There's the market symptoms and then there's psychological symptoms. So looking at the market, sharp increases in prices. So we have a short-term, strong trend where the stock prices shoot up. Think about the housing market crash. Think about the AI right now, how stock prices have kind of shot up really quick in that particular sector. Also think about the tech or the dot-com crash in the early 2000s, when the stock market was so high and so hot because of the internet and all the possibilities of the internet, and then it came crashing down. So definitely a sharp increase in the stock prices. Then we have overvaluation. The prices far exceed their historical norms or fundamental value. Fundamentalists like myself, people who always look at the fundamentals of the business and kind of pride ourselves in always doing that, we look at what the company is doing and then we compare that to the price. And then we say this doesn't look like the company is going to continue to perform to support this valuation. So that typically happens in the market. Then you have the tricky part, the significant earnings. This is where it gets tricky. When looking at these AI stocks, especially NVIDIA, they have revenues that are growing very, very fast, amazing rate, 122% last year, and then 60% before that. So actually growing at very astronomical rates. So revenue and earnings are going up. So it kind of makes you think that the company is performing at a level where it's going to support these valuations that are so high. Because if it continues to do that, then it's going to be great. But do these companies actually continue to grow at those astronomical rates? That's the question you have to ask yourself. So those are the three market symptoms that always happen in a bubble. Now we have the psychological psychological symptoms. These are the things that makes people fall victim to these bubbles. The stories justifying price action. We always say, hey, it's different this time. This is a new era. You have to look at these businesses differently. We always say that, and that's how we kind of justify what's going on instead of accepting the fact that we may be in a bubble. So that's one psychological issue. Another one, envy and regret. We suffer from having the fear of missing out. We see someone getting, or a stock going up and giving people lots of gains in a very quick time or fast amount of time, and we want that. We don't want to miss out. we may think, hey, this might be a mistake if we don't jump in and grab this stock and get involved in this surge that's happening. So that's the other psychological factor. Another one, media frenzy. We get tricked by media because you got to understand, media, they want your attention. They're not your advisors. They're going to say whatever they have to say on TV to get your attention when it comes to these stocks. So of course, AI is the big hot topic. That's what they're going to talk about. And then we hear that and it impacts our sentiment and how we view these stocks. So these are the three things that impact our psychology when it comes to stock market bubbles. So we always want to keep these things in mind. These are the 6 characteristics of a bubble. Now let's talk about the phases of a stock bubble. The first is the stealth phase. This is when there's a new product or technology, and sometimes it could be policy or regulation or even deregulation, allowing for lower interest rates and easy flow of capital. The thing is, a lot of times it's both. It's both a technology or in a product and deregulation, typically happening in combination, that creates this bubble. This is where all the funding and easy money comes from these businesses, where they can pump so much money into this area. So that typically happens in the stealth phase. So of course it creates new opportunities and pretty much a new way of doing business. Examples, like I said, the internet in the 90s. So the internet was created in 83. So all that time up until about the mid 90s, that's the stealth phase of that .com bubble. Also deregulation. So Taxpayer Relief Act of 97, causing housing to be pretty much the only asset where people will get this capital gains exclusion. So this makes a lot of people want homes, which is what the government wanted. They wanted people to buy homes. But then you also had deregulation, which allowed for subprime loans. So we'll get into that later on how that housing market crash happened. So phase number 2, you have the awareness. This is where the adoption kind of comes in on this new technology or product. So during the awareness phase, the impact of the catalyst that happened in the stealth phase becomes evident. You can actually see the market moving in a particular way because of that particular catalyst. New trends start to emerge and investors begin to adopt the opportunity and see it as a legit opportunity. So as we go into some of the historical bubbles that we're going to discuss, you'll definitely see that in the examples. Phase 3, this is the boom. This is the mania. This is where there's a widespread adoption. So you have the awareness where people start to adopt it and see it. Then you have the widespread where more people begin to use it. And right now with the AI, think about how you thought about AI before ChatGPT came out. Artificial intelligence, it existed and we knew people used it, but to what extent we did not know. Then we saw how now we have AI on our computers and now we have apps on our phones, and even social media sites like, Facebook and Google, they're incorporating AI in their apps now. So even you can't avoid it. It's in your face. Now everybody has seen the potential of it. That creates this mania and boom that we're seeing right now. So phase 3, mania, the media attention, the hype and enthusiasm. And then you have the greed. Everybody wants to hurry up and get a hold of that fast money or take advantage of this significant surge that's going on. Then you have the delusion phase, where it's clearly a bubble, but people are delusional about it. We start to justify what's going on in the market. Again, the new paradigm, a new way of thinking is how we have to look at this different than other assets because of these few things. And then we end up falling victim to it. Now, again, the tricky part, corporate profit surge. That's the tricky part. That's the hard part about this. You see, these businesses are having success because of all this investment. And then it tricks the investor to think that this is going to be the new normal versus a bubble that's getting ready to pop. Then we get to that downfall phase. We get to the point where there's a huge sell-off. We're still in denial. We're still kind of hoping something we don't lose our wealth because we want to be optimistic and we're believing that our money is going to grow in the market, and it has grown to an extent. But when that bubble pops and it begins to fall, we don't want to accept that. So some of us end up holding the bag and we want to avoid being there. So when the wave is over, people don't accept it. Then you have your fear and despair as things are going down, and corporate growth slows dramatically. What happens in the tech bubble, what happened, a lot of people or a lot of businesses were putting so much investment into the internet and internet companies. It got to a point where companies decided, okay, we don't have to invest this much, or we've invested enough. And then all of a sudden, a lot of the companies stopped the investment into the internet companies, and those internet companies suffer because of that. That's the trigger to the downfall there. So looking at the total graph showing all four phases, the stealth, awareness, mania, and the bust phase, or the downfall phase, there's one part about this chart that's the most important, and it's the mean. Notice here, with all these high valuations, everything ended up falling back to the mean. This is called mean reversion. Or this is one way to look at mean reversion. The main way is looking at competition, and this is another way. This is the actual trend of the value of these businesses or these products. It's slowly growing, but because of the surge here, we assume that it's growing fast. NVIDIA grew 122% as far as revenue growth. I don't believe NVIDIA was 122% better in just 1 year. They did have some significant revenue growth for that 1 year because of the wide adoption of AI, because they are definitely a leader in that space. But did they get 122% better as a business in 1 year just because they had that business growth? No. Are they going to be able to sustain that in the future for a long period of time? Not likely. So you always have to think about that. No matter how fast this goes up, and even if you miss out, don't feel bad if you miss out on these surges. This always happens in the future. It always comes back to the mean. The stock or the asset prices is going to trend earnings for a long period of time. So if you're a long-term investor like I am, we don't panic when these things happen or whether we miss out or not. We're going to have opportunities in the future as the bubble pops, it comes down, and we can get the stock at fair valuations. May not always be a discount depending on the business, but at the very least, you want a fair valuation when you're buying stocks. So this is the most important factor. Always think, no matter where a stock is, whether it's undervalued or overvalued, one day it's going to come to the mean. And a wise investor understands this, and we take advantage of this. When the stock is undervalued, we'll buy because we believe it's going to come back up to the mean. When it's overvalued, some of us might short the stock because we believe it's going to come back down to the mean. So we want to take advantage and use the miscalculations of the market to build our wealth. So let's get into some historical examples of market bubbles, and we'll look at what happened and how they worked, and we'll kind of keep this chart in mind as we're going through these examples to see how they mirror this right here. So in Holland, the Dutch people became very obsessed over tulips, and it became a very highly priced possession. So the wealthy people, they always liked it, but it happened to where the middle class in about the mid 1630s, the middle class joined the craze, and they also was just obsessed with tulips and wanted so many of them. So here we have the cost of tulips. Tulips, one tulip bulb was the price of 4 oxen, 12 sheep, or 1,000 pounds of cheese. And particularly these tulips that were multicolored, these were the most prized possessions. Like, people were mortgaging their house to get money to buy bulbs with hopes of selling it at higher prices when they grew in the spring. So it pretty much took over their market. It was pretty much the driver of wealth to these people. So after this happened, all of a sudden, people just didn't want the tulips anymore. The demand just disappeared. And in 1637, people were no longer interested. The government had to come in and force people to pay 3.5% of the contracts. The government understood that there's no real value in these tulips, and people did sign these contracts that they didn't want to honor. But hey, if you sign to pay $100, you have to pay at least 3.5%. So $3.50. So people who mortgaged their house bought these bulbs and had to sell the tulips for 3.5% of what they planned on receiving. So this was kind of the first major bubbles that's documented where this happened. Crazy demand, a surge in price is driving the wealth of the economy, and then all of a sudden the demand dissipates. The Japanese bubble economy in the 80s. Now, remember we talked about the catalyst. It could be a product or technology, and it also could be deregulation. And here it's mostly a deregulation. So in the mid 80s or 70s, there was deregulation of financial markets. Banks had a whole lot more free range to go out and get customers and throw capital around. And that's what they did. So in the mid 80s, businesses who had cheap access to capital, who took the money and they can get cheap capital so they can invest in different ventures. So that spurs the economy because people are seeing that you're spending money when they're reading your analyst reports and financial reports. They're saying that you have confidence as a management team that you're going to build more revenues in the future. And that's why you're spending this money. So we're optimistic. So they took that money and did some investing, but these businesses also took that money and put it back into this market that was overvalued and put it into more speculative investments, which pretty much grew their profits artificially in a sense. So if I'm a business and I buy some securities and I held that on my balance sheet, as that goes up, the values of those securities goes up, I have to report that on my income statement. So this is what's happening. So as an investor, we're seeing these corporate profits go up, but they're going up artificially. A lot of the profits reported was from an overvalued market. So the government, of course, just like what the Fed does in the United States, they will raise interest rates to cool off the market. And as soon as that happened, the market comes crashing down. And the government, they had to raise those interest rates very aggressively to get control of the market. And here comes the bubble crashing down, where you have a real estate, which was a big driver of the economy, the value of their real estate. You know, Japan being a smaller country and also having lots of their land being mountainous region. The real estate that was there is already valuable. With this bubble, it became even more valued, and the asset price and asset value was so separated from each other. A crash happened when those interest rates came down. Came up, I should say. Now, here's the thing. Japan had some of the highest growth in the 70s and the 80s. But after the bubble, as an industrial late nation, they had the slowest growth in the 90s because it took about a decade for the economy to recover, similar to the dot-com bubble. So speaking of which, the dot-com bubble. So now, this is one that's more recent, and so I'm gonna talk about this one a little bit more since I'm assuming the viewers are going to understand this one more than the other ones. So, of course, we know that the internet was created in 1983. So from 83 to the early 90s, that's the stealth phase. We know of it, might have heard of it, might have not known anything about it. I was born in 83, so I didn't know anything about it. So come 1995, people are seeing this as a new way of doing business, and it definitely was a new way of doing business. This is where the tricky thing happens with some of these bubbles, because you see evidence of the growth. You see, like, I think in 1995, 16 million people had computers in their home, or 16 million people in the US used the internet. In 96, that 16 went to 45 million. So it was a pretty fast adoption phase that happened when we began to adopt it and became aware of the internet. So you had a lot of .com or internet startups that was able to get capital very easily, of course, with the hype and euphoria and people seeing evidence of the power of the internet. A lot of companies started and went public without making a profit. So a lot of businesses that weren't viable to last on their own, they did not have the cash flow, they were only depending on investment. And there was a ton of investment going into these companies. Of course, the media craze, a lot of mergers and acquisition activity. And after a while, one of the factors was Y2K, if you remember that. When people found out, Y2K didn't really happen, nothing really crashed. All this money that we were putting into data security, maybe we can pull back on that. So that began to happen in 2000. And between March and August was kind of the peak of that .com bubble. And afterwards, the investments into these companies started to come down. Companies could not get the debt to last. Again, they were not making profits. So you had so many companies that were not profitable that everybody was optimistic about. And the asset prices were much, much higher than the actual proof of the operations of the business. The businesses were not profitable, were not cash flowing. So when the funding left, those businesses failed. A lot of them failed. On top of, you had the fraud with some Enron and WorldCom and other companies overinflating profits. So you had that combination going on as well. And again, the pressure to actually produce a return was pretty much on the shoulders of these businesses who could not do it, and things came crashing down. By 2002, the stock market lost $5 trillion in value. So from 2000 to 2002, $5 trillion gone out of the market. And we didn't recover from that until about late 2006. I want to say December 2006 is when the stock market reached back to that 2000 level. And then, as we know, the housing crash happened right after that. So we had another major dip afterwards. So if you were invested in 2000 and you held your investments, the only income or practically the only increase that you received from that 10-year period came from dividends. So in 2010, that's when the market kind of rebounded to get back to where it was in around 2000, the 2000 levels. So that's how devastating this crash was. And then for it to be coupled with another crash 7 years later, it was pretty, they call it the lost decade. That's a decade where our market really did not produce any returns outside of dividends. So the last part, how do we avoid becoming victim to a stock market bubble? Number one, don't justify the bubble. The words that kill most people's wealth is it's different this time. Often it's not different. It's typically the same thing. This is why we call it the market cycle. The market repeats. It does the same thing over and over and over. So bubbles are a thing. When we're in one, be careful to not justify it. Accept it for what it is. Be prudent about the fundamentals of businesses and protect yourself. Number two, don't chase stock surges. Remember what I said. Stocks revert to the mean. The actual true value of the business actually trends at a slower rate, much slower rate than stock volatility. Stocks will go up and down much faster than the actual value of the business. So always keep this in mind. If you're trying to chase a stock and you're not sure when it's going to crash, you don't have to chase stocks. You don't have to chase it. Invest wisely. Make sure you have the conviction in your investments that you're choosing. So no matter what, if you don't have investments in NVIDIA, you're happy with the stocks that you do have. If NVIDIA surges, that's fine. There's going to be opportunities to buy it at great valuations in the future. And number three, don't invest without regard to the fundamentals of the business. Always, always, always evaluate the fundamentals of the business. You need to know what the income growth is. You need to know how fast the industry that the company competes in is growing. You need to understand what the balance sheet health is, if it's a healthy balance sheet or not. Are they cash flowing? Do they have the cash flow to handle their obligations that are on their balance sheet? And the future growth of that cash flow, you have to understand if the earnings are quality or if the earnings are from different anomalies when it comes to selling off different assets and revaluing assets. You want the company's operations, the EBITDA, the operating income, to be consistent and growing. This is how you understand whether the business is quality or not. Always, you want to invest in quality businesses no matter what. And I invite you to check out some of my stock analysis videos where I do just that. I go through the revenues, I go through the cash flows, the profitability of the businesses. I look at the balance sheet. How fast can this company pay off their debt with their cash flow? I also do a dividend analysis. Looking at the shares outstanding, I want to know what the company is doing with their shares, if they're selling it or if they're buying back shares. I want to know that. I want to see where that cash is coming from. And I also do a discount cash flow valuation, giving me an idea of what I think the company is worth at the time. So check out those videos. So I hope this video gives you a great idea of what a stock bubble is, what it looks like, the factors that play into it as far as what the market is doing and what we as investors are doing psychologically and how we fall victim to these bubbles. So I hope this video was helpful. Please let me know what you think about it in the comments, and I hope to see you in the next video.